With market volatility continuing to storm, investors' nerves are understandably getting frayed. This week we talk about why the storms are neither fatal nor forever. So here we are in the midst of this storm, hard to avoid market turmoil, political turmoil here over this last month. We strongly encourage you that at times like this, one of the things you need to do is just take on some measure of acceptance, that these things are outside of your control, that there isn't going to be a singular move, a singular predictive data point that is going to help make it all better or help give you the answers to what lies next. And in fact, as we'll cover, a lot of times when you're seeing a lot of conflicting data, it lets you know that far from being a definitive move one way or another, we're probably stuck within a range, and that is how we feel right now. So when you're evaluating markets, one of the big confusing points that we see with people is two big things. One is when they're listening to someone, they're not taking into account what type of analysis they're using. Is it more fundamental? Is it more technical? Is it more quantitative? And then time frames. Are they talking about what they think might happen over the next 2 months? I'm really bearish over the next 2 months. Are they talking about 2 years? Are they talking about 5 years? That, again, is a level of detail that usually TV doesn't have time for, or might be too confusing to try to put in to words within a written article, and yet is so critical to really understanding where things lie. Take right now. From a fundamental perspective, most of the data points that anyone can put their thumb on, it's called hard data because it actually can be objectively quantified into a number, looks okay. Recent retail sales were okay. GDP's holding up. Labor market hasn't fallen out of bed. A lot of people are confused by this given all the turmoil. The quick narrative that seems to be out there as well, people are just pulling forward their activity because of the tariffs. That could be true, but perhaps the economy is far more strong, resilient than people are giving it credit for. We won't know, and so therefore it's not going to be one of those things that could be predictive. From a quantitative standpoint, a lot of people have made noise about this. This is everything you're reading about investor sentiment, small business sentiment, consumer sentiment. That's been pretty bleak. And so there's this contrast between the two. The team at Renaissance Macro, we include a quote in the written commentary this week from them, talk about when those two things are in conflict, to maybe lean more toward the soft data, that would tend to be more predictive of where things are headed in the future. But a lot of times, is it's range bound. It's going to be bounced. There's an equal measure of good and bad or difficult things that are going to keep the market relatively stuck. And that's really frustrating as an investor. Again, it helps add to that pressure, all those challenges to patience that try to encourage you to make, again, a rash or a logical decision. It might feel good in the moment. With a little bit of hindsight, you realize, man, I really jumped the gun on that. From a technical perspective, looking at things like the volatility index, it's just recently come back below 30 this week after being elevated ever since the announcement earlier this month. If you look at trends, most of those are broken down into what we would refer to as a bearish trend. And so again, just a lot of different data. Tom Essay in the written piece, you can read a nice breakdown of him. Again, takes this as we would and says this is likely going to create a range-bound market where we're kind of stuck between roughly 5,000 and 5,500 on the S&P because there's just nothing definitive to push things all the way one way or the other. At the end of the day, while all this volatility and lack of clarity is incredibly frustrating, and we get it, and we're here for you because of it, volatility does not equal risk unless you have an arbitrary time frame. And it's just so important to realize that fact. Volatility are just temporary moves in value. Risk is a permanent impairment of capital, but you don't have to take things into the risk category unless you have to be a buyer or a seller at a given point in time. So first of all, how do you buy yourself more time? Well, we've talked about this. For those needs you should have a defined cash flow source. It might be a job, certainly could be your investment portfolio designed to help you meet those needs that are known. You also want parts of your portfolio that are not related to the others, that are likely to do okay during times like this when other things like risk assets aren't doing as well. And there are plenty of those assets within portfolios today. These are to help you with those unknown needs that might arise or enable you to be a buyer of things when they're on sale. Second point around time frames, getting yourself time is to know that while again, it feels at these times that they will never end, that they are forever, as we said up front, They're not. In fact, markets recover far quicker than most people think. If you look at this first chart, it's from First Trust Fund Company. They took a look at all the times the markets hit a 10% correction, looked at the 1, 2, 3-year numbers, and what you see is your odds of being positive after such of a pullback 1, 2, 3 years later range from the high 80s to the low 90s in terms of a probability of success rate with solidly positive returns. 1 or 2 years later, median return of over 20%. On a 3-year average, a median annual return of over 15. The second chart, because we get from a lot of people, well, this one's even deeper, this one's even worse. What JP Morgan found, looking at 15% drawdowns all the way down to 25, is actually the deeper the drawdown, the higher the probability of success. With a 15% drawdown average from the day it hits moving forward, about 83%. At a 25% drawdown level, you're again up into the low 90s with double-digit type annual returns. So none of that is predictive, but it does let you know that, again, all these similar moments that came with similar fears, even if the narratives or the stories, the causes might have been slightly different, the net result was the same. A lack of clarity, a lack of confusion usually resolve themselves much quicker than our emotions tell us they will. And that's, again, one of things, along with great preparation and planning and portfolio design, that can give you the confidence to know we're going to get through it. If you have any more questions, reach out at any time. Thanks as always for watching.